We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Michael Kao, former hedge fund manager, commodities trader, and private family office investor. He's also the author of Cowboy Musings on Substack. Michael, thanks for joining me again. How are you?
Hey, thanks for having me. Thanks for being patient. Tom, to your credit, you've been very persistent in hounding me for a couple of months. And, I'm not one to really to do interviews or write stuff when I have nothing to say. But now I feel like there's plenty to talk about. So thanks for keeping after me.
Not a problem. I don't like hounding people. I don't like being a pain in people's ass. But, considering let's say the framework of what you've written and what you've kind of laid out here, which we're going to go over today, I think it's well worth the wait. So to kind of set the stage a little bit for today's discussion, I think it's important to understand from your perspective how these economic shifts and strategies put in place by Trump et al. Are shaping up for the US and by extension, let's say the rest of the world's reaction to it. Like, what are the major catalysts that Trump has put in place, or Trump and his team have put in place, that are creating this big change in the world?
Well, okay, so first I'll go back to a piece that I wrote all the way back in March, and I called it Navigating the Asteroid Field with Trump 2.0. And I basically, in that piece, it was the first time I really thought about what the Trump 2.0 playbook looks like. Because look, there's, in this world of Trump derangement syndrome, right, there's a lot of just reflexive talk that, all his policies are like shooting from the hip and, just like random almost, right? And certainly the rollout was quite chaotic. But I've always thought that, like, when you look at the big picture and you look at what the underlying economic team is trying to accomplish, they inherited a pretty difficult set of circumstances, right? And I laid them out in that piece. I basically said that, look, this current trajectory that we've been on is a 7% non-wartime, non-recession deficit at full employment. That's a big problem. That gives you no cushion if shit goes bad. Also, Janet Yellen left us with this massive, deficit and being funded with short-term bills. Other big problem, and something that still hasn't been resolved. Multiple global conflicts around the world. This border crisis we've had, a sticky inflation problem that we've had for a number of years now. And then perhaps most importantly, this terrible dependence on our adversaries and unstable regions of the world for what I call these critical path industries. And so when I'm thinking, if I were advising the Trump administration, so when I wrote that piece, I really thought, okay, if I'm an advisor to the administration, how the heck do we navigate this asteroid field, right? I use my Star Wars analogy of like trying to weave through that asteroid field, because if you don't weave through that asteroid field, you're going to get caught by the empire, right? but so that current trajectory was a doomed trajectory. To escape the empire and the doomed trajectory, you have to go through this fraught path. And the fraught path is what I kind of say, okay, well, I'm echoing some of the things that Bessent said, which is, look, they're targeting a 3% deficit. Ultimately, it's still not nirvana, right? Considering we actually reached a budget surplus briefly, and we're going to talk about that in the late 90s. But the first order of business is try to cut the deficit down to 3%. Eventually term out our debt, rely on longer term debt financing. And then create macro conditions for sustainably lower rates. We'll talk about that, but that's I believe that's a work in process. It's the jury's out on that. But I think one of the key things that the Trump 2.0 administration has done so far is convince the Saudis to relax their their unilateral supply cuts, right? And so I've been saying quite some time on X, on Substack, that every time there's a geopolitical spike in oil, it's been a fade because the real geopolitical risk was to the downside. I wrote about this like a year before Trump even got elected. I said, should Trump get elected, be prepared for a Q1 25 surprise where he convinces the Saudis to basically release all that spare capacity. And we're seeing it happening in real time right now. So that's my bullet point for creating sustainable conditions for sustainably lower interest rates. My view is that oil is such a critical commodity and feedstock to so many parts of the economy that even when we start talking about tariffs, right, there's a lot of debate right now on whether or not tariffs are going to drive inflation. Mm-hmm. Well, they will drive inflation in certain areas, right? But especially if the goods have no U.S. substitutes and the demand is relatively inelastic. But you're not going to see wholesale runaway inflation with or without tariff inflation, because I think that oil, if you keep a damper on oil, I think inflation will remain relatively subdued. And we can go into that also. And then most recently I wrote a piece that kind of graded the Trump 2.0 policies on all of these dimensions. And so the last two things on this like intended trajectory I'll mention are, shifting this. I've said it on our past interviews that part of the problem with our economy, the way it's been architected over the last several decades, is we've gotten into this vodka Red Bull dynamic where there's so much fiscal largesse coming from the government. That's the fiscal Red Bull, that it's created an inflation problem that then needs to be tempered with monetary depressant, the monetary vodka, if you will, right? Mm-hmm. And so then what happens is that both sides, and if you think about it, both the fiscal Red Bull, both the Red Bull and the monetary depressant are key contributors to our deficit. Fiscal Red Bull, obviously, because it's government spending, and then the monetary depressant with high rates. Well, interest expense is one of the biggest line items of our budget deficit now, right? So how do we undo that vodka Red Bull dynamic? And one of the things I'm going to go into is what I call the Reversemarshalplan. I think one of the big accomplishments so far of the Trump 2.0 playbook is to get a lot of foreign countries and private industry to start shouldering some of that fiscal Red Bull. So whatever other countries and companies spend on our country's behalf is capital that our government no longer needs to spend down the line. NATO spending is a key component of that. So that original Zelensky meeting that was lauded as just a horrific meeting on all fronts turned out to be exactly the catalyst that we needed to get Germany to relax their fiscal debt brake from 2% to now they're talking about getting their defense spending up to 5% by 2035. That's a huge deal. And then of course, and part of this what I call fiscal Red Bull redirection is allowing us to direct that spending into these critical path industries. When you look at China, they've had this like vision for 2025 10 years ago where, they talked about, okay, here are like 10 critical industries that we need to be number one or number two in or something like that. And these are all like critical path industries, including like rare earths, for instance. And so it's interesting because I've always been a free markets guy, but the problem is that when you have a globalization that is not based upon true comparative advantage, right? True comparative advantage is where one country A is great at fishing, country B is great at making widgets, and then they trade, and then 1 + 1 = 2.5 or 3, right? That's a true globalized economy. This globalization that we've had, that people are worried that Trump 2.0 is basically breaking down. That was a bullshit fake globalization, not based on comparative advantage, because China is running what I call this runaway assembly line. For 4 decades, they've urbanized their population based upon real estate development, and that whole jig is up. They can't do that anymore. There's been a huge amount of capital waste and misdirection, and so now they've turned that fiscal spigot, right, to industrial capacity. So what that results in is this runaway assembly line where they're churning out goods nonstop. They cannot stop because they need it to keep some semblance of GDP growth and their masses gainfully employed. And so, but what that means is that for any country that is engaged in, and that runaway assembly line is directed at those critical path industries that they identified, right? Mm-hmm. So you see the problem here, right? You've got this a structural dynamic from China where they are exporting what is essentially hostile industrial policy that will hollow out any competitor that's pursuing a free market path. Mm-hmm. Because look, it's just cheaper to just buy Chinese goods. Let's just forget about manufacturing anything here. Let's just buy everything from China. Well, the problem is that China is our biggest geopolitical adversary. So and that's how we got into this mess. So now we have to unwind it, and it's a fraught path. But so far, I like what I see. Mm-hmm.
I mean, there's so much to pick up on, obviously. You just yes. laid out like the entire framework, but let's just start with, how do you think about the demographic problem that China ends up facing here? They have so many of these long-term strategies in place. And I think a lot of them, and especially, being that industrial conveyor belt, as you mentioned,
yeah,
a lot of that ends up kind of running into problems if they don't have the people to be able to manufacture all those goods.
Well, look, that part, I'm less concerned about that part for China because they are working on automation, right? My much bigger concern is who's going to consume all that stuff they're making, right? Mm-hmm. Because as Peter Zeihan once said at this geopolitical summit I chaired like 2 or 3 years ago, somebody asked exactly that question, like, can China solve its demographic time bomb with robots and automation? And Peter quipped, robots don't eat, and that's a big problem, right? So I have no doubt that they're still going to be able to churn out goods and this runaway assembly line dynamic, even as their population goes down, especially with advances in robotics and AI. But it fundamentally, it will create a major problem for the rest of the world if the rest of the world doesn't fight back, because China, I really don't see a way out for them to develop an internal consumer economy. The demographics, you just can't. How are you going to do that? Mm-hmm. And so that's why, like, at the outset of this tariff war, everybody, lots of naysayers on the Trump tariff strategy, but I felt like one of the lone voices defending it, because I felt like he's absolutely right in being able to wield the leverage of our consumer market. The U.S. consumer consumes like 35% of global consumption. Mm-hmm. And so like, if you turn that off via a punitive tariff, that essentially acts as an embargo, right? Remember the days of the 145% tariffs? That's effectively an embargo. Well, those goods, I found it absolutely preposterous when maybe it was Macron or someone else. I think it was Macron who was saying, well, we obviously need to turn to China more. And I put out a lot of tweets back in April and May saying, that would exactly be akin to inviting the fox right into the hen house. Mm-hmm. Because what will happen if you play it out to the end is that if the U.S. Shuts its consumer off from China, China will turn all of those exports to Southeast Asia and to the EU. And honestly, a lot of the exports to Southeast Asia are basically making their way back to U.S. shores via transshipment loopholes, which I also predicted would get shut down. I wrote a series of tweets back in April saying, for those CEOs who are considering, rejiggering your supply chains to, some other Southeast Asian countries, consider whether they are aligned with China or aligned with the U.S. Because if you choose poorly, you're going to wind up seeing the same thing happen. And we really saw that, right? Like if you take that Vietnam deal, right, you saw that, like, I can't remember the tariff number. I think it was like 20 or 25% tariffs, but then on transshipped goods, it was like double the amount. It was like 40 or 45%. So the administration is pursuing this economic statecraft exactly the way I would want to see them do it on behalf of America. And for the EU to say that, the solution is to align more closely with China, well, be my guest, because then you will see your entire industrial sector get hollowed out very, very quickly, because all of those displaced goods that are no longer being absorbed by the US will wind up on EU shores.
Mm-hmm. So, Michael, I think as well, another thing that we need to be taking into consideration here is, let's say, the timeline that these changes need to be able to have in order to show if they're effective or not. So do you think it's possible, let's give it a decade for these strategies? I mean, this is obviously a major shift and a major change in how not only the US works, but also the global economy. If we're able to, or if the Trump administration is able to somehow implement this plan over the next decade, is that going to give the US the fiscal Red Bull that it needs in order to grow its way out of this $37 trillion debt problem at this point?
Yeah. So this past piece that I wrote about a month ago, I called it, where are we in the asteroid field, right? So it was basically revisiting my March piece, except now with a couple of months of actual policies to kind of give like a report card, if you will, on how Trump 2.0 is doing. And so I talk about that a little bit, and let's just go right to this fiscal Red Bull redirection. Well, first of all, in this piece, I basically said, okay, there's four broad policy levers or policy initiatives that Trump 2.0 has undertaken, and I'll talk about each one. One was the tariffs and economic statecraft, right, which we've kind of talked about a little bit. Second is redirecting that fiscal Red Bull. The third is keeping inflation subdued and eventually terming out the debt. And four is containing internal and external threats. We can talk about all four if you'd like. But so number one, on the tariffs and economic statecraft, I think that the administration is doing the right thing. There are still some Section 232 sector specific tariffs that are probably coming down the pike. And I've actually said that, look, I do think that it never made sense to me why we would necessarily have tariffs on what I call t-shirts and tchotchkes, because look, we don't care. We want to be able to have cheap Chinese goods in areas that are not vital to national security. Mm-hmm. But in critical path industries like chips, shipbuilding, pharmaceuticals, defense, energy, right? Yeah, right. These areas, I think, need to be targeted, but they need to be targeted in a way with some sort of ratcheting mechanism, right? Because a lot of these areas, like for instance, like pharma or energy, these are relatively demand inelastic goods. And so if you instantly slap them with like 50% tariffs, yes, you will create an inflation problem. So those need to be have some sort of ratchet mechanism. But what I like about what the administration has done from an economic statecraft perspective, and this is really, it breaks the rules on the last multiple decades of trade negotiations. If you think about the trade negotiations that we've seen over the last multiple decades with presidents from both sides of the aisle, it's been focused on this multilateral kumbaya trade agreements, right? That I've also written that the problem with those is that China has been very, very adept at something called salami slicing. Salami slicing is a geopolitical term that basically means that, when you undertake incremental measures that, when looked at alone, they're not enough to provoke a response. But when you add up the cumulative effect of them, it's very significant. And then you couple that with the fact that China is very, very adept at probing weaknesses in these multilateral deals. These multilateral deals, the problem is that there's always a lowest common denominator effect, where you're only as good as your weakest link, right? So they've been able to figure out little chinks in the armor, if you will, and exploit all these loopholes. So what the administration has done is it's basically done away with that entire format, and it's basically negotiating bilateral bespoke deals. And I think that's the way to prevent the salami slicing, even do a little bit of salami slicing ourselves, because when you look at the grand strategy behind all of these deals, it's not just tariffs, it's bundling these economic statecraft goals, including what I'll call this Reversemarshalplan thing, where getting countries to commit to certain reshoring commitments at the same time, right? And so I think your question is a good one, because the challenge that the U.S. faces is that we have a 4-year election cycle, and if one of Trump's proteges doesn't get reelected, and in 2028, then a Democratic president comes on and tries to undo all of these things, then we're back on the old trajectory, in my opinion. So what I think, if I were advising the administration, I would want to see a bunch of these commitments. I want to see these countries that are making these big fiscal commitments on our behalf to get pregnant in these projects. I think these cannot be on the come projects that you're going to start in 3 years' time. Mm-hmm. They have to be now. And I want to see them essentially get pregnant on these things, so that they're not easy to unwind. So yeah.
So, Michael, how do you think Scott Bessent thinks about terming out the debt? You had mentioned earlier that Yellen, of course, issued much of the debt during her term on the short end of the curve, and so far Bessent has done a little bit of the same. But will his strategy change over time, do you think?
He has no choice yet, because the yield curve is saying that the inflation problem is not gone, right? And so let's talk about that for a second, because I think that that's ultimately the critical piece. 2021, I saw that we were going to have an inflation problem. I wrote this piece a long time ago. I called it "Oil and the U.S. Dollar Wrecking Ball," because saying that this huge spike in oil, plus all of this fiscal largesse, plus all of this monetary largesse at the same time, would create this inflation problem, which we wound up getting. And so we still have this almost 3%. Core inflation, right? That hasn't gone down. What's changed to make me think that there's actually light at the end of the tunnel? Despite, by the way, it's not lost on me that, risk assets are at like all-time highs, and it looks like, everything is like firing on all cylinders. Well, the thing is, number one, the stock market is not necessarily the real economy. And, ever since I became a family office investor, I invested across a lot of different asset classes, not just stocks. But like when you look at, for instance, like real estate, multifamily, for instance, multifamily has basically been in a recession for 2 years now. And then when you see like the latest labor revisions, you're definitely starting to see more cracks. I've been very, very annoyed at Powell because, I don't support Trump's bullying of the Fed, but I do think that Trump is right in saying that Powell is always late. I've been calling Powell the master of skating to where the puck was, not he's the anti-Gretzky of Fed chairs. So because look, I mean, he was obviously late with team transitory back in 2021, and then then he finally found religion, and I thought, okay, here we go. This is good. But then for whatever reason, right before elections, he turns massively dovish and cuts 150 basis points, when to me there was no sign of any conflict between the dual mandates of the Fed, right? But now, he's now turned hawkish again when things are not nearly as clean as they were a year ago, right? One way clean as they were a year ago, in my opinion. So that's not necessarily to say that I don't support what Trump is saying. He should cut 300 basis points. No way. Mm-hmm. But are we probably too restrictive? In my mind, actually, yes, because I think that the tariffs are actually going to weigh on the economy. I think that the tariffs, this is why I think the Trump 2.0 playbook on when taken in its entirety is net deflationary. When you have a deflationary playbook meeting a pre-existing inflationary backdrop, the hope is that they cancel each other out and you can have disinflationary growth, right? That's the hope. That's the holy grail. That's what we had in the 90s. And what I think is underestimated by the market are the deflationary impacts of getting Saudis to relax their oil supply cuts and getting oil down, which is, again, a primary feedstock of so many parts of the economy, not just transportation, but industrial production and petrochemicals, for instance, which then feed into all these other sectors, right? And then also the deflationary impacts of tariff-driven demand destruction. So, and that is going to be a little bit nuanced too, right? Because when we talked about the critical path goods, that I think there should be tariffs, punitive tariffs on to incentivize reshoring. Well, if those goods are demand inelastic and lack U.S. substitutes, there has to be some sort of ratchet mechanism. Otherwise, you will stoke inflation in those sectors. But if it's T-shirts and tchotchkes or even automobiles, I don't see a problem having tariffs that are punitive enough to incentivize either reshoring or good substitution to U.S. substitutes, because that's the whole geopolitical objective. That's the economic statecraft objective. So I do think that the playbook on a whole is a deflationary playbook. Now, this redirecting of the Fiscalredbull is a big deal, because in my latest piece, Where Are We in the Asteroid Field, I talked about how, look, the biggest disappointment for me so far, and the part where I give the administration's efforts a C, are the cuts, right? Because Doge turned out to be a nothing burger, as we all know. And then the big, beautiful bill, while it had a lot of good things in it in terms of growth initiatives. There was precious little in cuts, right? But I'm hopeful that I'm hearing that there's going to be another reconciliation bill that's going to address more deregulation and more spending cuts down the pike. We shall see about that. But but what I give the administration an A on is the fiscal Red Bull redirection, because let's just talk about this for a second. From in May, when Trump toured the Middle East, he got huge amounts of commitments from Saudi Arabia, Qatar, and UAE, right, over the next 10 years, right? From the July trade deals and August trade deals, right, between Japan, EU, Philippines, South Korea, that's another $2 trillion. Okay, so I'll just mention the headline numbers, and then we can debate whether the headline numbers even make sense or need to be massively discounted. The total Mideast commitments were something like $3 trillion over 10 years. The July and August trade deals were something like two and a half, to the tune of $2.5 trillion. Mm-hmm. And then there were a whole bunch of corporate reshoring commitments from the likes of NVIDIA, TSMC, Apple, Eli Lilly, AstraZeneca. All of that, when you combine them, totaled another $1.25 billion. And then you talk about the fiscal Red Bull redirection via NATO, which I think is a big deal. Defense Red Bull is one of our biggest line items in the deficit. That on a cumulative basis, I did some analysis on that. The cumulative increase in spend that the EU is now saying that they will shoulder is another 2.9 trillion. So when you add all this up, the headline number is close to $10 trillion over 10 years, right? Now
that really goes back to the point about letting this be able to play out over the next decade, right? Right.
So I think I've also written that, okay, there's certain things, right? So for instance, like the trade deal commitments, some of the Middle East commitments need to be haircut a lot, right? Maybe even like 70, 80, 90%, right? But then when I look, because the overall number is so big, and I do think that the probably the most solid parts of the reshoring commitments are the NATO and maybe some of the corporate commitments, right? NATO, because I do think that that fateful Zelensky meeting many months ago, I think, made the EU understand that they need to take very seriously their own defense, given this aggressor is right in their own backyard, right? And we'll see what comes of like the recent talks, and that's another interesting topic of conversation, because that's another area where I've been talking about, beware the peace black swans. We'll segue to that later, but let's just finish this talk. So if the aggregate total amount of fiscal Red Bull direction is a headline 10 trillion or so, whatever, you want to haircut that by 70%, fine. Even if it's a relatively paltry $3 trillion, that $3 trillion, by the way, is the exact amount that the CBO has estimated that the Big Beautiful Bill is going to add to our deficit, right? $3 trillion. But even there, right? So forget the fact that this Reversemarshalplan of spending, and Bessent has actually said in an interview that the administration views it as getting the rest of the world to fund essentially a sovereign wealth fund for the U.S., which to me is basically like the Reversemarshalplan. It's basically an opportunity for the U.S. taxpayer to get a little bit of payback over the fiscal largesse that the U.S. has extended to the rest of the world over the last several decades. So I think that is brilliant, and in and of itself could counteract even the most bearish estimates of the CBO. Now let's talk about the CBO for a second, because I have a big problem with their I think the CBO projections tend to get a little politicized. And so when they talk about their $3.3 trillion increase based on the big beautiful bill, I found this chart from Deutsche Bank that I found really interesting. It basically showed that their estimates were based on 1.2% productivity growth. And when I did some research, 1.2% productivity growth was basically the trough productivity growth that we saw from the period of 1973 all the way to like the early 90s, where it was like that's basically the lowest productivity growth that we've seen over the last several decades. Well, that's what CBO used. They later came on and issued kind of a mea culpa and said, oh, well, if we assume that productivity can improve by 50 basis points to 1.7%, our projected debt to GDP of 150% by 2035 actually goes down to 100%. Like, shit, that's a big freaking deal, right? Mm-hmm. That's a huge deal. Now, I did some more analysis and I looked at like, okay, what was productivity growth during the heady days of the internet boom and the internet revolution in the mid 90s, right? It was like 2.7 to 3.5% productivity growth. So with the help of my AI analyst, I did some more digging and said, okay, let's assume that we can get to that AI is at least as productive as that initial internet boom. What could debt to GDP get to? We could see debt to GDP get to 50%. If we wind up getting something like high twos productivity growth. So to me, that is the holy grail, right? Like if we can have a deflationary policy playbook that counteracts a pre-existing inflationary backdrop to have a disinflationary growth enabled and supercharged by deregulation initiatives and AI, you can have this Goldilocks deleveraging where we are growing our way out of this deficit. You see debt to GDP actually plummet without runaway inflation. And so again, look, it's a fraught path, right, to get there. And a lot of it rests upon whether or not some of these initiatives can continue. And I think that's why I think that with respect to some of the reshoring initiatives, it's very important to insist that the people who made those commitments get pregnant in those projects and not just have it be like, on the come, promises. That's what I would be advising the administration. And then if you can do that, that's when you can term out the debt. I think terming out the debt is going to take some doing because you can't brute force it. You can't brute force it. I think that's going to, if you brute force it, like what Japan did with yield curve control, that's what leads to this predicament that they have right now, where they seem to no longer be able to control the long end of the JGB curve, and they have an inflation problem. So I don't think you can brute force that. You need to create natural conditions for lower rates.
So how do you think Bessent and the Treasury team goes about doing that, Michael? The Genius Act is something that is pointed to that's going to bring new demand for treasuries and bonds. How big do you think that the size of that market actually is? And, is it possible that stablecoins end up kind of replacing the SWIFT system as well?
Well, I do think it's interesting. And that's the part where I think that's a big wild card. And I'm not willing to speculate too much on that. And I'm not necessarily counting on it. I think it's interesting that a US dollar backed stable coin can be the equivalent of like the euro dollar of the future, right? If you will. I think that's interesting. I just don't have a good sense for whether or not that generates a massive amount of incremental demand for US dollars and US treasuries. But let's face it, I've always been in this camp, this skeptical camp about de-dollarization, right? And we can go there a little bit on this conversation. And because if this de-dollarization, someone said the other day, in response to my tweet about beware of the peace black swans, in that if you look at this latest bout of de-dollarization initiatives by whatever, like China, BRICS, you name it, it was really instigated by Russia's 2022 invasion of Ukraine and then the subsequent sanctions. I worked on this West Point paper in 2023 where we basically said, it's a mistake actually for the U.S. to over rely on sanctions, because even though I see the U.S. dollar and U.S. Treasury ecosystem as pretty impregnable at this point, given lack of substitutes, why create incentives for other countries to re-architect a parallel system around the U.S. dollar, right? Well, what I call the reason why I say beware peace black swans is I'll never underestimate Trump's ability to surprise markets and rug pull markets. And peace black swans refers to all of the anti-dollar trades that have benefited from this geopolitical instability we've had over the last several years, whether you're talking about Russia, Ukraine, or the Middle East, or China, Taiwan. And if peace were to break out and that incentive to re-architect away from really the most liquid and deep and supply elastic ecosystem out there, what if that incentive to flee that ecosystem goes away? Well, beware the asset classes that have benefited most from that re-architecting, right? And so I find it very interesting that today, on the in response to what seemed to be pretty constructive talks between Zelensky and the EU leaders, that you're seeing oil get smacked, gold get smacked, Bitcoin get smacked, and those are what I call the peace black swans. Mm-hmm.
Is it possible that we see a lot more, if Ukraine starts to wind down, and I know that these aren't mutually exclusive, obviously, but do you see Israel hostilities ramping up again as another potential conflict zone again?
Well, I think that the decapitation of Iran's senior leadership and also the defanging of their nuclear program, I think, unbelievably, again, this is another area that I've been very pleasantly surprised. But by doing that, I actually think that it paves the way for a potential restart of the Abraham Accords, and with the big kahuna being trying to land Saudi Arabia in it. Last week I released a very interesting podcast. It was a Chaos Theory number 10. Our guest was named Kim Gaddis. She's an Emmy award-winning author and strategist that's a Middle East expert. She's not as convinced, but the whole point of that podcast was to delve into the root causes of conflict, especially sectarian conflict in the Middle East. And what I find very interesting about the Middle East is that you have these sectarian cross currents between Shia, Sunni, between Iran, Saudi Arabia, and then of course you've also got the Muslim versus Israel, impetus. And all of these, we talked about this in our podcast, but all of these cross currents kind of intersect and run in parallel. And one of the questions that's still lingering in my mind after doing that interview was, what's the relative strength of some of these conflicts? In other words, does the unity of all of the Muslim countries against Israel supersede the internal sectarian conflicts between Sunni and Shia, Iran and Saudi? or the other way around. And I'm cautiously optimistic that even though whenever there's an Israeli attack on Hamas or whatever, or you've seen a lot of headlines where Saudi Arabia and some of the other Muslim countries will say, we want to see a two-state solution. We want to see an end to the hostilities, blah blah blah. But I also think that now that I have a better understanding of the very deep-rooted sectarian differences, I think Saudis were very happy underlying all of this. They were very happy that Iran got set back militarily and especially on their nuclear program. So if Iran, in fronting all of these proxy groups like Hamas, Hezbollah, the Houthis, the three H's, I call them, if Iran's ability to export its influence has been diminished, and its ability to throw a wrench into what seemed like a pretty optimistic start with the Abraham Accords during Trump 1.0. I think if that impetus is diminished, I'm hopeful that there could be a restart to Abraham Accords. And if Saudi reaches a rapprochement with Israel, that would be, I think, a game changer for the Middle East.
Mm-hmm. It's interesting to consider what you said about let's say the relative strength of these conflicts and or the relative influence that they end up having within the world, and I think especially the markets. You've been very focused on the oil markets for a really long time, and something that I was trying to wrap my head around, and I think I hopefully learned a lot from, was this Israel-Iran conflict and let's say the non-confirmation that by the oil market that it was as big of a deal as it was being made out to be. So how do you see that? Do you need that confirmation from the markets in order to truly understand how big the actual conflict is going to be?
Yeah, I would say yes, but like sometimes, right? The market always has a knee-jerk oil spike on any of these headlines. I mean, just very recently, it had a knee-jerk spike on increased sanctions on Russia, right? And every single time, I've been saying that you can't have a runaway. This is not the oil market of 1973, where they were able to successfully embargo. In 1973, the U.S. was a non-player in global oil production. Number one, and number two, you didn't have this big overhang of spare capacity, right? So if you think about what the Saudis have done, they had unilaterally withdrawn 3 million barrels per day of their production capacity over the last several years to support the price of oil. That's a huge overhang, and they got themselves into an untenable situation where eventually that had to be unwound because they were ceding market share, not just to U.S. shale, but to other members of OPEC, Russia, Iran, UAE. So they've now unwound about 2.2 million, I believe, of that 3 million. They've unwound about 2/3 of their unilateral cuts. They can still unwind another million and change. And so I really think, especially given Trump's rapport with MBS, I think that Trump will continue to convince MBS to keep a lid on oil prices. I think there's a flood of oil coming, and I'll never forget what I term the Trump rug pull of Q4 of 2018. because I got hurt by that rug pull, and so I learned some lessons from that. And what happened there was Trump had pulled us out of JCPOA, and oil prices started to spike. And he asked the Saudis to basically, flood the market to kind of, displace those Iranian barrels, all the while promising that there would be no waivers on Iranian sanctions. Well, Q4 2018, end of October, he grants 11 waivers as the Saudi barrels are already kind of in the system, about to hit our shores, right? Price of oil collapsed and took a lot of people, including myself, by surprise. So when I say beware the peace black swans, I'm partially talking about oil and the potential for a very similar thing to happen, although oil has already been declining. Mm-hmm. But I'm also talking about his ability to just rug pull other markets. Just when you think that the safe haven trade is going to be, gold for the foreseeable future, right? He might just do something to upset the apple cart and surprise you in a way that you just didn't expect. That's why I call it a peace black swan. Mm-hmm. So, but it's very interesting to see today's reaction. Definitely, like when I look at gold and oil and Bitcoin, I think Bitcoin probably hit its peak. It was like what, 125,000, like about a week ago. So yeah, look, this is still just a drop in the bucket, obviously, right? But mm-hmm. the question I pose is, what if the regime is actually changing again, right? And because I always said, when I wrote this Trump asteroid piece, I tend to think of a lot of things, the world, in real option terms, right? So when I think about this past trajectory that the U.S. was on, I think of it as a very low volatility death spiral, where relatively low vol presidents on both sides of the aisle have pursued the same policies over and over again over the span of decades, and it's basically frog boiled the U.S. population into thinking that everything is okay. Having a 7% deficit is okay. It's just like a slow, low vol death spiral. What I see in Trump, to think about it in terms of him as a option, in option terms, is that he's a high vol president. So when you're in a low vol death spiral, what you actually want is a high vol catalyst to shake things up, and so that you have a wider dispersion of outcomes. Mm-hmm. And hopefully the outcomes, given that we're already on this downward trajectory, hopefully there's an asymmetry to the outcomes where the dispersion is asymmetrically to the upside, right? Mm-hmm. And so that's what I think of this playbook. This playbook was an aggressive playbook with respect to, especially with the tariffs and economic statecraft. But I think it's working. I think, knock on wood, but I think there have been some big wins, and the primary thing is to isolate, I believe, China, and to try to get, that. I don't know what the final China deal is going to look like, but I do think that there are a lot of concerns that Trump's going to make a deal and do like an end game and screw everybody else but give China a sweetheart deal. I just don't see it. Trump has been railing about China for a long time, and I do think that he's on the right path in terms of prioritizing China and and I think that the reason why, when you talk about his focus on, one of my grading criteria in this latest piece I wrote was his handling of the internal and external conflicts. And internal, I mean, border security, right? But external conflicts, I'm talking about for instance, trying to diffuse these volatile situations between Russia, Ukraine, and in the Middle East and China, Taiwan. It's very much reminiscent of if you're a Roman history fan, as I am, there's something called the crisis of the third century, where, I mean, you talk about history rhyming. The Roman Empire in the 200s was experiencing runaway inflation. They were experiencing multiple geopolitical threats from without. They were experiencing civil unrest from within. They had a border problem. They also had a problem with plague. I mean, it's eerie, right? How this, and so that created this crisis of the third century, where for a period of 50, 60 years, between, call it 225 AD and 275 AD, it was a shit show, and there was no good leadership. And finally, between Aurelian and Diocletian, they come to power. Diocletian famously enacted some very, very controversial but aggressive reforms, and it kind of turned things around for a bit. And so I think that we're similar to Diocletian and Aurelian. Trump is a sort of high vol controversial candidate, but his playbook overall, I think, has been very consequential for the U.S. And mainly positive, I would say. There's a lot of stupid shit that he does that I don't like. The pumping of shit coins, and even accepting that Qatari jet. I mean, why create controversy when you just didn't have to create controversy? So I definitely don't give him a blank check on everything, but on the things that really, really matter for getting us off of the current trajectory, I think his playbook has been good.
Mm-hmm. Well, just to drill into that a little bit more, what do you think is his target level for oil to be able to, create that, in some ways, deflationary pressure from that most important energy factor that goes into basically every single piece of the economy? Well, look, I'm kind of talking against my own book here, because I still have a sizable exposure in this legacy oil private equity, right? So all things equal, I'd rather see higher oil prices myself. But I think, again, trying to divorce myself from my own wall, and this is why I also hedge. I have XOP puts right now. I think that getting oil down into the low 50s is probably his objective. And if I were advising the president on what's good for America, that's what I would want him to try to advocate for. Because why? Because in the low 50s, shale is not dead. They're still making money, but they'll be stacking rigs. They'll be delaying completions. They're going to basically retrench and survive. But if oil goes down into the 30s and 40s, that's going to put some shale companies out of business, right? And no one wants that. And the thing is, you don't want. So I think if he can get oil down into that neighborhood, especially during this very crucial time where his policies are going to be politically tested with respect to tariffs, right? That's going to do a lot in terms of blunting any sort of tariff inflation, I think. So I think getting oil lower sooner than later is more important. At some point, he's no longer going to have a control on oil, right? Because what will happen is that there's a lot of people, including my shale company, that think that shale has seen its best days already in terms of the A inventory that's already been drilled out,
and maybe the Permian, if not, if it hasn't peaked already, it's getting close to peaking in the next 2 years, let's say. And that's a big deal, because when the Permian does peak, there could be a cliff at some point in the future. So yeah, but at the same time, right? What's also interesting about what China has done is one of China's biggest geopolitical albatrosses, if you will, or weak points, was its dependence on oil and the so-called Malacca Strait, right? Because they have to import something like 90% of their oil through this tiny little Strait of Malacca. China, ironically, because the Saudis have done these inexplicable unilateral cuts over the last several years, they've allowed they kind of screwed themselves in my way of thinking about it, because by keeping oil artificially high, think about it, it accomplished three things that were long-term bearish for oil. By keeping things artificially high, they allowed shale to really benefit and continue to invest in the sector, right? Number two, at the time, they were fighting the Fed. The Fed was trying to counter an internal inflation problem, and their primary monetary lever was raising rates. But if you think about what raising oil prices does, right, it has the same demand destructive effect as raising rates. So their policy tool was also aiding the Fed in fighting inflation and fighting demand, right? So that's number two, that wasn't good for them longer term. Number three, and this is probably the biggest deal, by having relatively high oil prices, it really encouraged China to find a substitute and really try to hedge its Malacca dilemma. And how did they hedge? Well, China's really electrified its economy far faster than the US, right? They've basically, their EV penetration is far deeper than the US. And so what that means is that it's displaced oil and gasoline as a key transportation fuel, because by EVs, as you know, right, are consuming electricity. And then where's the electricity produced? Well, how is it produced? Either through coal or nuclear. And China's building heavy amounts of both. And so if China successfully, there are a lot of people, including my favorite analyst Lakshmi, who think that China's oil demand has already peaked. And so that's going to be a structural secular problem for oil. So it just might be, though, that even as the Permian supply is peaking, you're also seeing the demand peaking at the same time. So which force wins out more over the long run remains to be seen.
So, Michael, if we get this, let's say this peace black swan, as you've mentioned it, and lower oil prices, in general terms, how do you kind of express your conviction in this, Trump, this new way that America has of operating? How do you express your trading view within that?
Well, I don't say I've been very leery of this whole. Remember, like when at post-Liberation Day, right? There were a lot of voices, smart voices, I would add, that were basically saying this is the end of U.S. American exceptionalism. Mm-hmm. That this would you would see a potential, multi-year rotation out of U.S. assets, out of the dollar, out of U.S. assets. I just posted this thing yesterday that shows.
I'll put that chart up in the
video.
Yeah.
I mean, it's pretty amazing, right? I mean, you saw like this V bottom, and like we're at all-time highs in terms of demand for U.S. assets, whether they're just U.S. assets across the board,
especially stocks.
especially stocks. And so I would never bet against America. And I think that especially where in America that might be turning the corner in its own crisis of the not third century, but 21st century, right? Because I think that there is a way out of this sort of low vol doomsday trajectory. And I think it took some very bold initiatives on behalf of from this current administration, both geopolitically and from a sort of macroeconomic perspective. So I wouldn't bet against America on that front. I think the U.S. dollar and the U.S. dollar ecosystem is here to stay. I'm not concerned about the bond market. I think the bond market, this where the yield curve is and where yields are is more cyclical than structural phenomenon. I completely disagree with the whole Ray Dalio, doomsday projection. I think that. But look, is there risk to my view? For sure, there's risk, right? In fact, my view is still the non-consensus view. Our biggest issue actually is that we have a 4-year presidential cycle that's somewhat unpredictable, and that one set of policies that could be very good long-term policies, which I think the current ones are, could be undone. And so the question is, how do you at least sow some seeds that aren't so easily uprooted once they take hold? And I think with respect to that Reversemarshalplan, you got to get some of these guys to start with some of these projects. And I also think that deregulation, we really haven't talked about deregulation yet. But I think deregulation is going to play, if we see like another bill, another legislative push, it'll be on that front. I think deregulation will help a lot in terms of unleashing that productivity boom. So so long term, I'm not worried about the U.S. Treasury. I've also said, look, another thing I'll just touch on is that I've also said for years now that when people look at debt to GDP, right, that is a measure of stock to flow, and it's only looking at the liability side of the balance sheet with respect to the current flow. What about stock to stock measures? Because we have 37 trillion in debt, but there's some estimates that the left side of the U.S. balance sheet could be as big as 500 trillion. The U.S. is really endowed with an incredible amount of resources and geographic and geopolitical assets that are hard to value, and so the question is, when in the early days of the administration, when Bessent and Letnick talked about this idea of having like a sovereign wealth fund, I thought, well, this is really interesting because this is the first time that any administration that I can remember has even acknowledged that there's a left side of the balance sheet that can be brought to bear. Mm-hmm. And so this Genius Act and stablecoin thing is one thing, one way of creating demand, and deregulating banks, quite frankly, is another way of creating demand for treasuries. But I think that this notion of marshaling the left side of the balance sheet is a huge one, and I'm not quite sure how it will all play out yet. But this Reversemarshalplan that's resulting from the Economicstatecraft and these trade deals is a very interesting construct, because it's as if we're getting the rest of the world and private industry to shoulder some of that fiscal Red Bull. And that is so significant, right? Because as I said at the outset, other people spending fiscal Red Bull on the US economy and infrastructure means that it's money that the US government does not need to spend. So you might not see it yet now in terms of actual cuts, but if try to envisage a world where NATO, all of the countries are now, shouldering their own defense burden and paying and spending 5% of their respective GDP. It will mean that the way I look at it is it'll benefit the U.S. no matter what, because either we can actually cut our own defense fiscal Red Bull, or redirect at least what we're currently spending and pivot more towards the Indo-Pacific, which I think it's needed most ultimately.
Yeah, I mean, there's so many cross currents here to consider, and I think the way that you laid out these deflationary versus inflationary forces, and really this larger sense of what the changes are and how they're progressing is, it was really helpful for me to kind of look at it from this different point of view, Michael. So I appreciate you laying that all out
Thanks for having me. Back in February, I wrote a piece about this where like the reason why I think the deflationary parts of the Trump 2.0 playbook outweigh the inflationary are that even so for instance, deregulation, that's a pretty deflationary force, right? Getting oil prices down, that's clearly a deflationary force. But the more controversial ones were tariffs and also the deportations, right? Well, tariffs we've already talked about, because tariffs, even though they're depending on the industry, there's a demand destructive aspect that's a countervailing force, right? But then with respect to the deportations, right? Yes, on the one hand, you're reducing labor supply in certain parts, but at the same time, you're also reducing housing demand and demand for goods and services at the same time. So even the controversial ones that most people took as knee-jerk inflationary, I would say maybe they're neutral to maybe even net deflationary. But when you look at everything together, I think it's a deflationary playbook. When and the hope, again, like I said, is there's a difference between deflationary and disinflationary, right? Disinflationary is just lack of inflation, whereas deflationary is like lowering prices. Well, if you have a deflationary playbook meeting a pre-existing inflationary backdrop and impetus, hopefully the result is you can have disinflationary growth, which is what we had in the early 90s that allowed us to have for a very brief period of time, a budget surplus.
Yeah, it's all really interesting stuff to try to wrap our heads around and to make sure that we consider, so that we don't get surprised by, these, or get surprised if you do take a big position on something. So as always, I appreciate it, Michael. Of course, all of your excellent writing is all available at urbancowboy.com, and that's spelled KAOBOY.com. And of course, Urban Cowboy on X as well.
Thanks so much for having me.
It was an
thanks for your persistence.
Absolutely, Michael. We'll have to do it again when you're ready.
Yes, absolutely. Thanks.
Right.
Thanks for having me.
Thanks so much for your time, Michael. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.